Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. The first week of each month is packed with influential economic data that can impact the bond market, thus affecting interest rates. This week was no different, with scheduled economic data and unexpected events in banking sector causing a stir. The orderly failure of First Republic Bank and rumors of other potential bank failures caused a run on various bank stocks, which required temporary halts to trading. Lower job openings on Tuesday, along with bank drama, sent bond yields lower. I saw this more prominently in 2-year Treasury yields, which have more in common with Fed funds rate compared to the 10-year Treasuries. The Fed's widely anticipated 0.25% hike to the Fed funds rate came a day later, but interest rates continued to trend lower until midweek before bouncing after a strong jobs report on Friday. Overall, the 10-year Treasury yields traded within a range of approximately 0.25%, while 2-year yields had a range closer to 0.5%. It was a volatile week, but it did not break any new ground with regards to the ranges I've seen or been monitoring in the 10-year yield. Without the non-farm payroll report on Friday, one could have claimed that the yields were approaching the lower end of the range. Mortgage rates have been somewhat stagnant, similar to Treasuries. They have been moving sideways with a more constrained range and hovering around a fixed rate of 6.5% for a 30-year mortgage. This week's potential market volatility is concentrated on Wednesday morning when the Consumer Price Index, or CPI, is released. CPI is the largest market influencer among the various inflation reports that are released each month, and it's the only report that could challenge non-farm payroll, NFP, as the most significant monthly data over the past few years. The market is trying to determine if inflation is in check and declining, or if it is persistent enough to require more rate hikes from the Federal Reserve, making every new update on inflation particularly interesting. This uncertainty is what causes consolidation pattern in mortgage rates. The most significant figure in the CPI data is the monthly core reading, which excludes food and energy prices as they are volatile and less elastic. It peaked at 0.8% at the highest levels and remains above the target range, though it has come down a bit. It would take a full year of 0.167% core inflation to meet the 2% target, which seems far off. However, if the market believes that this is the direction we're heading, interest rates would be lower than they currently are. Unfortunately, the year-over-year chart doesn't provide strong evidence for this just yet. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.